You see these logos every single day. The crisp white apple on your phone, the colorful Google G that seems to know everything before you even finish typing, the smiling Amazon arrow that delivers packages faster than you expect. And over time, these logos have stopped being just companies and have quietly become part of daily life itself, shaping how we work, shop, communicate, and even think. And at some point, you've probably also noticed something else happening in the background, something far less visible but far more powerful, which is the incredible wealth these companies have created for investors over decades. And sitting here in India, you may have wondered whether this wealth creation story was even meant for you. Whether investing in the US stock market was legal, practical, affordable, or simply something reserved for people with insider access or massive capital. And that feeling of being left out has kept many Indian investors on the sidelines for years. But the truth is that those barriers are mostly imagined, because investing in the US stock market from India is not only completely legal but clearly defined and regulated under the Reserve Bank of India's liberalized remittance scheme, which allows every Indian resident to invest up to $250,000 per financial year abroad. And this guide exists to remove confusion, fear, and hesitation by walking you through the entire journey step by step, from understanding why global investing matters in the first place to how exactly you can open an account, transfer money legally, buy your first US stock or ETF, understand taxes without stress, manage risk intelligently, and build a long-term global portfolio with confidence. Because before we talk about apps or paperwork, we must talk about the why. And the reason global investing matters is not because India is weak, but because concentration risk is real. Since your job, business, property, savings, and currency exposure are already tied to India. And when everything in your financial life depends on a single economy, you are vulnerable to local slowdowns, policy changes, inflation cycles, and currency movements, while investing in the US market adds geographic diversification, access to the world's largest economy, exposure to global leaders in technology, healthcare, finance, energy, and innovation, and participation in companies that earn revenue from across the globe rather than one country. And when you look at long-term data, you'll see that US indices, particularly technology-heavy ones, have historically delivered stronger compounded returns than most global markets, including India. Not because the US is perfect, but because it has consistently rewarded innovation, capital markets efficiency, and shareholder growth. And on top of that, Indian investors enjoy a unique and often underestimated advantage in the form of currency dynamics. Because over long periods, the Indian rupee has depreciated against the US dollar, which means when you invest in dollar-denominated assets, your returns come from two engines instead of one: the growth of the asset itself and the appreciation of the dollar relative to the rupee. So, even in years where US markets move sideways, your investment can still grow in rupee terms. And when markets rise, the effect compounds powerfully, which is why global investing is not about chasing trends, but about building resilience into your portfolio. And once that why is clear, the next question is legality. And this is where many myths exist because the RBI's liberalized remittance scheme explicitly allows Indian residents to remit money abroad for investment purposes, up to $250,000 per person per financial year, meaning a family can legally deploy far more collectively. And when you invest through this route, your transaction is documented, reported, and compliant, requiring only PEAN-based KYC and a simple declaration of purpose. So there is no gray area, no loophole, no risk of doing something unofficial. And with that clarity, the next step is choosing how to invest, because today technology has eliminated friction, allowing Indian investors to open US brokerage accounts through Indian fintech platforms, specialized global investing apps, traditional Indian brokers with international partnerships, or global brokers directly. And for most beginners, user-friendly Indian platforms make the most sense because they simplify KYC, handle paperwork, enable fractional investing, and integrate bank transfers smoothly. Though regardless of platform, it's important to understand fee structures, especially currency conversion spreads, which often matter more than brokerage itself. And once you've chosen a platform, the setup process is straightforward, involving digital KYC with PAN and Aadhaar, linking your Indian bank account, opening your US brokerage account, and initiating your first fund transfer under LRS by digitally signing a Form A2 declaration, transferring money via NEFT or RTGS, allowing the platform's banking partner to convert rupees to dollars, and waiting for the funds to settle in your US account, which usually takes anywhere from a few hours to 2 days. And once the dollars arrive, the real moment begins, because unlike Indian markets, the US market allows fractional investing, meaning you don't need to buy an entire share of an expensive company to participate. You can invest $10, $50, or $100 into any stock or ETF, allowing instant diversification even with small capital. And this is transformative because it lets you build a portfolio across multiple companies and indices from day one rather than putting all your money into one position. And the process of buying is simple. You search for a stock or ETF, choose the dollar amount, review the order, and confirm, with trades executing when US markets open during Indian evening hours. And once you own US assets, you must understand taxation, which sounds intimidating but becomes manageable once broken down, because remittances under LRS may attract tax collected at source only beyond 10 lakh rupees per year. And this TCS is refundable and adjustable against your final tax liability. Capital gains on US stocks are taxed only in India, with long-term gains applying after 24 months at 12.5%, and short-term gains taxed at your income slab rate. Dividends are subject to US withholding tax but protected by the India-US double taxation avoidance agreement, allowing you to claim foreign tax credit, so you never pay tax twice. And while one important consideration for larger portfolios is the US estate tax, which applies to direct holdings above $60,000 for non-residents, this risk can be managed through portfolio planning, joint holdings, or by using Indian mutual funds and ETFs that invest in US markets and do not attract estate tax exposure. And for many investors, a blended approach works best, combining direct US investing for flexibility and ownership with Indian-based international funds for simplicity, SIP investing, and estate planning comfort. And like any investment journey, this one carries risks, including market volatility, currency fluctuations, geopolitical developments, and concentration risk. But these risks are managed through long-term horizons, diversification across sectors and indices, disciplined investing through dollar cost averaging, and sensible allocation rather than emotional decision making. Because global investing is not about quick wins, but about positioning yourself for decades of growth. And when you step back and look at the full picture, what once seemed complicated becomes logical, structured, and accessible. Because you don't need crores, special permission, or insider knowledge. You only need clarity, patience, and the willingness to start. And by understanding the rules, platforms, taxes, and risks, you move from being a spectator of global wealth creation to an active participant, building a portfolio that reflects the reality of a connected world. And the most powerful part of this journey is that the first step is always the hardest, but once taken, it changes how you think about money, opportunity, and ownership forever. So the real question now is no longer whether you can invest in the US stock market from India, but when you will take that first step and which US stock or ETF will mark the beginning of your global investing journey.